Hello students, welcome to Drishti IAS. My name is Saloni Nandkyolier, and in this session we are going to study the Banking Laws Amendment Act of 2025. We will look at the key provisions of this act, and we'll also talk about a brief history of the evolution of banking laws in India. So this banking amendment laws, these laws, they were passed by the Parliament earlier this year, and now this act has been notified in 2 stages. So a lot of the provisions of this act, a lot of the sections of this act already came into force on the 1st of August 2025. And then some other sections came into force on the 1st of November 2025. So the Banking Laws Amendment Act, they have been notified in 2 stages. Stage 1, 1st August 2025. Stage 2, 1st November 2025. Now, before we discuss the key provisions of this act, why do you think there was a need to reform our banking sector? Why does any country need to reform its banking sector? So the need here is very, very straightforward, that the economic strength of any country, it depends upon how robust the banking system in that country is, how inclusive is the banking network. So in order to improve the economic strength, a country needs to keep on improving its banking system, keep on reforming its banking sector. That is why these banking laws of 2025 have also been passed. And this is not the first law. There have actually been a series of banking laws in India. So let us talk about these laws also in brief. So the first important banking law for us was the Reserve Bank of India Act 1934, through which RBI was formed. Then we have the Banking Regulation Act of 1949, which was the first legal framework in India to regulate our banks. Then we have the Banking Companies Acquisition and Transfer of Undertakings Act 1970 and 1980. Before this, something else also happened in 1969. What happened in 1969? 1969 was the year for the nationalization of 14 scheduled commercial banks, and these banks had a deposit of 50 CR or above. So these 14 scheduled commercial banks were nationalized in 1969, and then we have the acquisition and transfer of undertakings for certain banks in 1970 and 1980. Then there are some other acts. We have the Banking Regulation Amendment Act 2007-2012. From these, we basically fixed on the statutory liquidity ratio or the cash reserve ratio, or we introduced liquidity management in India. And then we have the Banking Regulation Amendment Act of 2020. Under this act, the powers of RBI were increased. So RBI was basically given more powers, special powers to regulate the cooperative banks in India through the Banking Regulation Amendment Act of 2020. And the next important act over here is the present act of Banking Laws Amendment Act 2025. Now, if I talk about the key goals of this act, here we wish to make the entire system more depositor centric. Then we want to reduce the procedural delays. Then we also want to improve the audit process. And finally, we want to bring about good governance in the entire banking system. When I talk about the provisions over here, it will be clear to you how these goals are going to be sought. But the major goals for these laws are to make the entire system more depositor centric, to reduce the procedural delays, to improve the audit process, and to increase good governance in the entire system. Now let's talk about the key provisions of this act. The first important one over here is that it has modernized the nomination framework. Now what is this? Now, when you open a savings account, or when you open a locker, or when you open a fixed deposit in a bank, you can have a nominee, correct? And the assets in your name are going to be transferred to your nominee if something were to happen to you. This is how the nomination system works. Earlier, you could have nominated only one person. You could have had only one nominee. And now this system has changed. So two things have been introduced over here. What are those two things? First one is the process of simultaneous nomination. Earlier, you could have had only one nominee. Now you can have up to 4 nominees. And you can divide your assets in a way that the total comes out to be 100%. You can give whatever amount you want to give to anybody, just the total should come out to be 100%. Now, this is especially helpful in the joint family setups. It is especially helpful if you want to divide your assets in a way that nobody is left out. So you can have a system of simultaneous nomination where you can nominate up to 4 nominees. So one, this has been introduced, and two, successive nomination has also been introduced. Now, what do you mean by successive nomination? Let's say if something were to happen to you, the amount is going to go to the first nominee. Now, you can also set the priority over here. First, something has to go to your first nominee. Now, if something happens to your first nominee, then all the amount is going to go to the second nominee. If something happens to the second nominee, the amount is going to go to the third nominee, so on and so forth. So here you can also set the priority, the order in which your assets should be transferred in case something were to happen to you or to your nominee. So two systems have been introduced. One is simultaneous nomination and two is successive nomination. This is how the entire nomination framework has been modernized. And all this is going to make the entire system what? More depositor centric. The first goal that I talked about. More depositor centric. Now let's talk about the second provision, redefinition of substantial interest. Now this substantial interest is in relation to the investors. Okay, let's say I am an investor in a bank. I have invested my money. If I have or I've bought some shares. So if I bought shares of worth 5 lakhs, under the previous provisions or under the previous laws, if I have invested 5 lakhs or above, I would be declared an investor of substantial interest. Okay, and then what is going to happen? I will be under heavy compliance and regulations. Now this amount was actually fixed in 1968. In 1968, 5 lakhs was a very huge amount. It was a very substantial amount in comparison to 2025. That is why back in that time in 1968, if somebody would have invested at least 5 lakhs in a company, that investor would be considered to be of substantial interest, and naturally he would be placed under heavy regulations and heavy compliance, which is not the case today. Because of inflation, our money starts to lose its value, and now this amount or this threshold has been increased to 2 CR. Now, in order to be an investor of substantial interest, a person will have to invest up to rupees 2 CR in a bank. So the threshold has increased from 5 lakhs to 2 CR. So this is the second provision, redefinition of substantial interest. So as to ease out the process for small investors and medium-sized investors so that they are not placed under these heavy regulations or compliance issues. Then we have governance in cooperative banks. So governance in cooperative banks has been improved by increasing the tenure of their directors, excluding the chairperson or whole-time directors. Now, in order to maintain continuity in the system, in order to bring out good governance, it was actually required that the tenure of the directors is increased so that there could be a continuity in the system. Earlier, this tenure used to be 8 years. 8 years for the directors in cooperative banks. Now this has been increased to 10 years. This is for the directors excluding the chairperson and whole-time directors. Their tenure has increased from 8 years to 10 years. Then we have the governance and audit reforms in PSP. So I told you that we want to ease out the audit process also over here. So how is that happening? Basically, these PSBs or public sector banks, they have actually been given a right to decide the remuneration of the auditors. They can decide how much are they going to pay that auditor for that audit process. So remuneration can be fixed. Naturally, they are going to attract more qualified investors or more qualified auditors over here, more professional auditors over here, because now remuneration has also come into picture. So this is going to ease out our audit process. It is going to make it more and more, it is going to improve the entire process over here. Efficiency of the process is going to increase because now we can fix the remuneration of the auditors. And we can also improve the governance in a way that any unclaimed fund, any unclaimed interest, any unclaimed bond that was lying idle with the bank, it can now be moved to a separate fund, which is the IEPF, Investor Education and Protection Fund. So a fund is being created, the Investor Education and Protector Fund, and all the unclaimed money, all the unclaimed interest, all the unclaimed fund that is there, it can now be moved to IEPF. And this way, the entire tracking of unclaimed fund is going to be easier because now it is not going to be sitting idle in different places. All the unclaimed fund can move to one big fund of IEPF, and the tracking process, the claiming process, if at all required, it can all get easier. So governance is going to improve. Then we have procedural efficiency in RBI reporting. So in order to reduce the procedural delays, procedural issues, ambiguity in deadlines has been removed. So earlier the reportings used to be very, very ambiguous, like the deadlines used to be very ambiguous, like last Friday, alternate Friday, like we need to submit these reports to the RBI by alternate Friday and things like that. No specific deadlines were given, and this led to operational delays, procedural delays. Now we can give specific deadlines. We don't have to be like, we cannot be ambiguous in our deadlines. We'll have to say like last day of the month or last day of the quarter. Something that is more defined, something that is not very ambiguous. So we have to define our deadlines accordingly so that these operational delays and procedural delays can be ruled out. So these are the major provisions that have been introduced under the Banking Laws Amendment Act of 2025. And the goal I already told you is to make it more depositor centric, to improve the audit process, to reduce the procedural delays, all these things, and to make it more investor friendly also, especially for our small and medium sized investors. That is what we are aiming to achieve by these acts or these entire set of provisions. So that was all for this video. I hope you were able to understand all the things that we discussed over here. Now let us look at a practice question for prelims. With reference to the Banking Laws Amendment Act 2025, consider the following statements. 1. The Act allows bank customers to appoint up to 4 nominees for their deposit accounts and lockers. 2. The threshold for defining substantial interest in a banking company has been raised from 5 lakhs to 2 crore. 3. Public sector banks can now transfer unclaimed interest and redemption amounts to the Investor Education and Protection Fund. 4. Cooperative bank directors other than chairperson and whole-time directors can now serve a maximum tenure of 15 years Which of the statements given above is or are correct? A. 1 and 2 only. B. 1, 2 and 3 only. C. 2, 3 and 4 only. Or D. 1, 2, 3 and 4. Please provide your answers in the comment section and we will meet in a new video. Thank you for watching.
For more informative content, like, share and subscribe, and do not forget to press the bell icon to get the notifications.